Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 15th. Hanukkah's begun. Christmas is looming, um, and we're doing our best to work through the busiest time of the year for us. If you're all free subscribers, you received on Saturday morning the complete outside the paywall version of our 2026 Outlook note. The response to the note has been exceptional. One of the best responses we've gotten. So we're thrilled about that, and we would urge all of you to read it. We're not going to review it. It'll take you some time, but it's we think it's quite a thought-provoking note about how we would expect things to unfold next year. Of course, things always change, and that's why you should become a paid subscriber to Ironsides Macro. So when things do change, we'll help you navigate those changes. For example, last year we did write a bearish note in late February. We're on CNBC talking about it and urged people cutting risk, and then held people off from re-engaging until right at the bottom, and that has everything to do with 40 years of experience in the markets, but also creating frameworks and using history to inform the future. So we'd urge you at this point to consider becoming a paid subscriber. We did write a brief note this week in between our Outlook note and then writing our macro themes note that we hope to publish on Wednesday. That one we will not put the entire note outside the paywall, nor will we do that with our year in review note. Become a paid subscriber and you can read those interesting notes as well. The macro themes note is one of our favorites to write all year because we try and go through 4 or 5 themes that we think are going to persist for the entire business cycle, decade, longer time period. So this week we wrote a note titled QE Restarts. And if you've been following our work, you know that we are very specific about the 3 channels that Fed large-scale asset purchases of longer duration securities works through. There is what the Fed describes as reserve management, and they announced $40 billion per month through tax day, roughly. They left themselves wiggle room on the quantity, but they also left themselves wiggle room on the duration of those purchases. So when they inject reserves into the system, we agree it doesn't have much of a macroeconomic effect. It can at the extreme, like in 2020 and 21, but generally speaking, $40 billion per month of bill purchases shouldn't have any macroeconomic effect. Purchasing longer duration securities, DE, duration easing, surely does. And they left themselves the flexibility to purchase up to 3-year maturities. That would impact the belly of the Treasury curve and would be restarting duration easing. So they restarted QE. They gave themselves the flexibility to restart DE. We totally disagree with the approach and would have much preferred the bank regulatory relief that's coming be implemented first. That will reduce demand for reserves and make these operations completely unnecessary to control repo rates. They're thinking they can have a level of control that actually dulls market discipline and is not good for the allocation of capital process over time anyway. We went on to talk about the press conference and how Chair Powell it has come around to our way of thinking on the birth-death model overestimation of small business employment. He's got 60 per month. We think his number's low. And we do think that the data we get this week and then the December data will likely push the Fed towards an additional rate cut in January, though that's not in the dot plot. That's not in the speeches we're hearing. But we think we don't really care what they say right now because the data could overwhelm them. And they're not that good at reading the data, anticipating the data anyway. So that's why the market responded favorably, is because the markets are a little more concerned about the labor market than the Fed is. That's why 10s got below 4% in the first place. We also commented this week on trade data, and we're expecting an IEPA decision any day now. We think that IEPA could be declared unlawful, but we think the remedy will fall way short of forcing refunds. The JOLTS data was quite weak, supporting our earlier point. Tech stocks are underperforming here, but net revisions are falling. The rate of change of earnings estimates has a powerful impact on stock prices, and those net revisions are falling. Again, that's a reason to follow us, is because that's one of our key little metrics on thinking about sector allocation and how the equity market will ebb and flow over time. When earnings estimates, the rate of change of earnings estimates are going up, multiples expand, stock prices go up. And of course, the reverse is true. And we've got a little bit of a stalling of the momentum in tech earnings right now. And that's part of the reason why the tech sector is starting to underperform. That may very well continue through earnings. Finally, as we mentioned, the response to our note was quite good. Generally speaking, the clients we saw in New York do think that the economy will likely accelerate next year, but then that could come with a higher cost of capital. So that's it for me this week. We'll come back in a week or so. Wish everyone a happy holiday period, and again, consider becoming a paid subscriber. You can see notes like our Outlook note every week. Thank you.